Welcome back to The Explainer. So today we are diving headfirst into, honestly, one of the most violent market shifts we've seen in recent memory. We're on a mission to track down exactly where the market's billions have seemingly just vanished to overnight.
I mean, listen to this number, negative $407 billion. Yep, you heard that right. That is the staggering amount of market value just totally erased from one single company, Micron, since June 25th. That is a breathtaking amount of wealth, wiped out literally in the blink of an eye. To put that into perspective, that's larger than the combined value of Qualcomm and Marvell. It immediately begs the question, right? Where on earth is all that capital actually going?
It's basically the ultimate follow-the-money mystery. What we're witnessing right now is this dramatic, plunging trend line of collapsing tech valuations, violently crossing paths with a surging wave of brand-new market winners. Because, this massive tech collapse isn't just money disappearing into thin air. Capital relocates. So who is actually cashing in on this massive rout?
Okay, let's really dive into this. To understand those new winners, we first have to understand the losers. Sentiment has completely shifted. Get this, 43% of global fund managers now view AI stocks as an outright bubble. That momentum trade, the one that pushed artificial intelligence literally into the stratosphere, yeah, it's fracturing. All that limitless optimism has suddenly hit a massive wall of reality.
And wow, does that bring us to the brutal reality of the semiconductor trade right now? We are looking at a severe 19% drop across the entire semiconductor index. But here's what's fascinating and honestly deeply paradoxical. This is happening despite record corporate earnings. Take TSMC, for example. They just posted a massive 77% profit jump and a $100 billion US investment pledge. Yet their shares are falling as overall market sentiment sours. And then there's IBM. They suffered a historic shock, issuing a profit warning that triggered a 25% plunge, literally the worst single-day drop in the company's entire history. The fundamentals are just completely disconnecting from the price action.
Now, this wasn't just a random tech sell-off happening in a vacuum. It was a global panic, triggered by very specific, compounding international headwinds. Over in the US, you've got a hawkish Federal Reserve basically signaling they prefer modestly higher rates rather than holding steady. Meanwhile, over in South Korea, a 6.4% drop in their benchmark index triggered massive margin liquidations. We're talking forced selling that completely wiped out over 300,000 retail trading accounts. Just brutal. Throw in the US readying 25% trade tariffs on Brazilian imports, and you have this perfect storm of global contagion that just forced investors to hit the panic button.
But we really have to separate the signal from all this noise. The narrative is shifting from a simple pullback into what we call a full-blown rotation. Capital is violently seeking safety, moving far away from overcrowded tech. So investors aren't necessarily fleeing the market entirely. Instead, they're picking up their chips and sliding them over to entirely different, far more defensive sectors.
If we actually trace the money, we can see massive outflows pouring right out of those crowded AI and tech trades and funneling directly into safe havens. It's capital flight, plain and simple. Just notice where the money is landing. Consumer staples has emerged as a top destination as investors seek refuge in reliable assets amidst all the chaos. Financials? They're seeing huge inflows as banks post stellar earnings and frankly just benefit from the sheer volume of this shift, and healthcare is catching major targeted inflows too, driven by strong earnings beats from the industry heavyweights. We are watching the great rotation happen in real time.
So the absolutely crucial point here is how individual companies are reacting to this tectonic shift. Take Netflix. Their revenue outlook dropped, and in response, management is eliminating its biannual engagement report. Kind of seems like a move to quietly obscure slowing growth amid some fierce competition. Then you have Verizon playing defense through aggressive cost-cutting. They're slashing thousands of jobs just to hit a massive $5 billion operating expense reduction target. But then, there's Warren Buffett. Berkshire Hathaway is playing a completely different game. They are safely hoarding a massive $400 billion cash reserve, and Buffett just deployed an estimated $8 billion in accelerated share buybacks. That strongly signals he sees deep value in his own defensive stock while everyone else is panicking.
Actually, if we stripped away all the market noise for a second, a really fascinating strategic divergence emerges at the very top of the tech food chain. On one side, we have what we could call the Mag 7 wildcatters. Think companies like Alphabet, Microsoft, and Meta. They are taking on immense financial risk, literally pouring hundreds of billions of dollars into massive, unproven AI infrastructure buildouts. But on the other side, you have the Apple refiners. Apple is actively restricting that high-risk R&D spend. Instead, they're focused on controlling the final consumer distribution pipeline,
which of course is their smartphones, just waiting to adopt the best models once they're actually proven by everyone else.
And this brilliantly illustrates a historical parallel that is playing out right now. Apple recently hit a record high of $333 by essentially acting as Wall Street's anti-AI trade. They are literally deploying John D. Rockefeller's mid-1800s Standard Oil playbook. Rockefeller, he didn't take the massive risk of drilling for oil himself. No way. He built the refineries and the pipelines, let the wildcatters take all the upfront risk, and then he just controlled the final distribution. Apple is doing the exact same thing with AI today. It is a calculated, absolutely brilliant defensive game.
But stepping back from those corporate titans for a moment, this whole situation leads us to that classic Wall Street question. Where are the customers' yachts? Amidst all this massive market volatility and frantic capital rotation, we need to take a grounded, honest look at who is actually walking away with the real profits here and who is being left behind holding the bag.
What emerges is a truly devastating wealth gap. Up top, institutions and investment banks are having an epic quarter, taking the other side of this trade. Goldman Sachs just hit a record $7.4 billion in stock trading revenue alone. Now, contrast that with the bleeding retail investor. The Robinhood Investor Index, which leans really heavy on those tech momentum darlings, has trailed the S&P 500 significantly. The average retail account size right now, sitting at just $12,000. It is a stark reality of a massive transfer of wealth. Institutions are generating record billions by executing and then fading these retail momentum trades.
So if the traditional AI software trade is crowded and institutional money is rotating, where exactly is the smart money heading next? Well, the investigation points directly to physical AI. Robotics is the new AI horizon, and the hard data absolutely backs us up. Japanese machine orders for industrial robots have surged 24.5% over the past year. That's one of the fastest increases on record. We're seeing massive physical catalysts too, with Tesla pivoting factory capacity toward their Optimus humanoid robots and Hyundai aggressively purchasing stakes in Boston Dynamics.
To really grasp this new frontier, we need to clearly break down the robotics universe into two actionable categories. First, we have the builders. These are the companies creating the core automation and physical products. We're talking Alphabet's Waymo robotaxis, Amazon running over 1 million warehouse robots, and Deere's autonomous tractors. Then, on the flip side, we have the picks and shovels. These are the companies supplying the critical components, the underlying systems, and the silicon. This is where NVIDIA's robotics compute, Texas Instruments factory automation chips, and Qualcomm's edge AI chips all come into play. It is absolutely vital to understand who is building the physical shell versus who is supplying the mechanical brain.
Now, aside from robotics, there's another major policy catalyst on the horizon that we are closely monitoring, and that is cryptocurrency. Crypto is at a major crossroads right now. On one side, we have the Clarity Act, which aims to create clear pathways for token sales outside of SEC purview. But the political variables surrounding it are incredibly complex. You have Donald Trump holding over $1 billion in crypto-tied investments, setting up a massive potential conflict of interest. At the exact same time, there's intense political friction from congressional Democrats. They are demanding a provision barring government officials from crypto investments as a strict condition for even passing the bill. Look, we're evaluating this strictly by the numbers. With lawmakers leaving for the August recess soon, the probability of this surviving is dipping below 20%. It's a highly polarizing issue for sure, but from an investment standpoint, it is simply a binary catalyst that we need to monitor from the sidelines.
Okay, looking ahead, let's map out the terminal watch list for the week ahead. These are the crucial data drops that will likely determine the market's next immediate move. Tuesday and Wednesday are all about closing the banking book. We'll be seeing pending earnings reports from regional powers, which will either confirm or deny the fundamental strength of this ongoing financial rotation we've been talking about. Then, Thursday is the big tech litmus test as Alphabet kicks off earnings. Believe me, markets will be intensely scrutinizing their return on investment for their massive AI spending. Finally, Friday brings the consumer pulse, giving us housing starts and the highly anticipated University of Michigan Consumer Sentiment Survey to really gauge retail health.
Wow, we have covered some incredible ground today in this explainer, tracking billions from speculative tech into safe havens and uncovering that stealth rotation into robotics. So I want to leave you with this final provocative thought. With the AI momentum trade clearly fractured and a massive transfer of wealth from retail to institutions effectively complete, is your portfolio prepared for the age of physical AI? Take a hard look at your own positioning with the information we've unpacked today. Thanks so much for joining me. Keep learning, and I'll catch you next time on The Explainer.